Okay, welcome back to the channel traders. Um, Today we are going to be breaking down one of the most important trading concepts of smart money. So, which is supply and demand, as we can see here. Now, you might have wondered why sometimes in a trade that is pushing upward, just get to a particular point and immediately react, start selling down. It is because of what we call supply. And the same thing happens if in the demand aspect, price gets to a zone and starts buying all the way up. It is because it is reacting from a level we call the demand. So now in today's teaching, as you stick with me, as you follow me very carefully, by the end of this video, you should be able to know what a supply or a demand zone is. You should also be able to identify them in your chart. Yeah, and not just identifying them, having a better way of trading them and becoming profitable with whatever knowledge you will get this period. Okay, so the first thing we want to see is what is demand and supply. What is demand and supply? Now, supply simply means sellers. The word sellers. When you hear the word supply, it has to do with selling something. Just like you say, someone is supplying you 100 phones. Now, the reason why you are the person is supplying you 100 phone is not because the person wants to supply you that 100 phones as a phone dealer, but because you demanded for 100 phones. So the person is supplying you based on your demand. Okay. Now, so um, when we talk about supply, we are referring to sellers. Sellers. And I say here that um, supply, when supply is greater than demand, price falls. Price falls. Yes, some of us might have um, done economics in secondary school, or you're studying it in the high institution, but even if you've not done economics before, you should know from market knowledge that when the supply is greater than the demand, imagine that you have more supply of phones. There are people that want to sell their own. What will they do? Because they want to sell their own and they know that there are many other persons having the same product, what will they do? They will reduce the price. So the price comes down when the supply is in great supply or is surplus. So the same thing happens when the demand becomes great. Now, the rate at which people will be buying it, we say when demand is greater than the supply, the price what rises. When you are demanding for phone and there are scarcity of that product, those people, just like we have fuel scarcity, at every time when there is fuel scarcity, what happens to the price of fuel? It increases. And that is the same thing with every product. When there is a less amount of supply of that product, those that have limited amount of that product tends to increase the price of the product. So when you are talking about demand, you are talking about buyers, those that are buying, buyers. So you're talking about the buyers. So what we are saying, in other words, is that there are zones in the market where it is more comfortable to buy, and there are zones in the market where it is very much comfortable to sell. Okay. Now, in when we talk about trading, I've just given an illustration of the real market example. But when we talk about trading, when you talk about trading, a supply zone is an area on your chart where big sellers previously have, you know, they have reacted from. Now, we have this zone here. Okay, let me just make use of this too. Let's say we have here as a zone. Now, buyers started buying at this point and they pushed this price upward. Now, what demand is means is that anytime price comes back into this zone, buyers are also willing to do what? To push it again to the upside. So this is what happens in the market. Now, conversely, if we have a zone here, which is the supply zone, so this happens to be the demand. So this is demand. Okay. Now, let's say for supply, we are saying that there is a zone, that the big banks started selling from and they sold down. When price move up to that zone, there is a tendency of they pushing the price to the downside. And do you know the reason for this? The reason is because the big banks will not put all of their money at the same time into this market. No, they won't do that. Now, let's say they have 100 million dollars, $100 million to put in this trade. They want to put $100 million in this trade. And now they will not start with the whole $100 million. They will put in $50 million. They put in 50 first, 50. So this 50 pushes this price to the upside, and then retail traders will be pushing it. That's why it will be having this, slow or sluggish movement. And then the moment it gets back into the zone, they will intentionally allow this market to come back to this zone because they want to trade with 100 million, but they have already put in 50 million. So now, the moment this is done, and price returns back to this point, they will put in the rest 50 million and push price to the upside. The same thing happens here. They want to sell with 100 million. They want to sell with 100 million. They will first of all put in 50 million first, and then the moment price moves, they want to what? They want to, you know, they want to put in the next 50 million. So this is what the big banks do. This is what the big banks do to move price. Okay. So now the thing we want to look at now is, how do I spot this supply zone? How do I spot this supply zone? Now, take for instance, you have an impulsive move from a zone. Let me use this box to create the zone. Now you have an impulsive move, or let me just take this off first. We'll have the zone. Let me show you how the zone is created. Now, you have an impulsive move upward this way, and then started coming back down, and gets to this point. Now, how do you spot this um, demand zone where you expect that this price should should you know um, buy from? This market is going this way. It has gone up this way, came down to this point, and probably it has done something like this before it got to this point. Before it got to this point, please, this. Now, it has done all of these things. We have here a break of structure. I have a video I created on this channel on break of structure. You can do well to search for it. Now, when you have this break of structure and then price is coming back down, there is a zone here that is responsible for this impulsive push to the upside. It is this zone that is called the demand. It is this zone that is called the demand because it is responsible for this break of structure to the upside. And now we say that you see some people will say it is the last sell candlestick before this bullish move. But I am saying to you that the last candlestick before an impulsive move is your demand. The last candlestick before your impulsive move is your what? Is your demand. The same thing happens in the case of the supply. You see the market coming this way and then break this structure with an impulsive move and then started going back down, and the moment it got to this zone, it pushed up. What did we see? We can see a break of structure here. A break of structure here. Now, the last candlestick before this impulsive move that broke structure is your demand. Is your supply rather. Is your supply. Is your supply. So we have it as your supply. So that's your supply zone. Okay? So anytime price leaves a particular zone very firmly, very impulsively, very quickly. Now, when it returns back to that zone, it has a tendency to what? To sell again. To sell again. So, we want to look at how this demand works. Of course, I've explained to us from here that these big banks, institutions, hedge fund traders, they don't put in all of their money. They put in just a few of their money. Now, the moment they put maybe half of the money and push price to the upside, they will expect the price to come back down to that zone. It is like a footprint. It is like a footprint. There's a saying, they say history will repeat itself. So it is like a footprint that these people put, the hedge fund traders and the institutional banks. Now, it is a footprint that they put that, excuse me, the moment price move away from a zone, firmly away from a zone, and returns back to that zone, it will also do what it did at the first time. So it will move away very quickly from that same zone. Now, I would want to show us a real chart example. This is 4 hour time frame. Let's go backward so we can see some number of examples. Okay, let's start from here. I think we are okay from here. Now, what can we see? We can see market all the way from here, came down, came back in, break structure, came back down, went back in, now break structure again, went back in, break structure again. Now, what did he start doing? He now start moving up, came back down, break structure, came back down, break structure, came back down, break structure, came back down, break structure. Now, let's analyze all of these things. Now, when price was coming all the way down, it came all the way down, and what happened? It went back it went back up into the last candle before this impulsive move. This is what I mean by impulsive move. You see this massive drop to the downside, this big candle. You see it's just black candle, no blue candle. It means that it is impulsive. Look at a gap between this first candle and this third candle is a gap here. So now this last candle before that impulsive move, this last candle before that impulsive move will now be your what? Your supply, because it is at this point that market move very fast away from it. So it means that price will return back into it and also what? Still move down. Now when we add our break of structure here, the moment you get your break of structure, the next thing you want to look at is the next supply zone, because we are in a downtrend, right? So I've talked about market structure. This is the next candle before the massive move that broke the structure. What happened? Price came back into it, right? So we have another break of structure here. Now, where is the last candle before this big move to the downside? Where do we have it? We have it here. This is it. This is the last candle. And what did price do? After price came back, it came back into it and did what again? And break structure. You know, I've talked about market structure. You can see, if you are just new to this channel, go and search for market structure. I've created a video on market structure. It's here in my channel. So this doji candle is another supply. What did price do? It came into it and came down. Now, it did not break structure again to the downside. What did we see? We now saw price breaking highs. Now it took out this eye. Took out this eye. This is not a break of structure. It's not a valid break of structure. A valid break of structure should close with a body candle, but this is just a wick. So this is where we add that break of structure. Now, where is the last candle before the break of structure? Here is the last candle before that break of structure. This is it. And that is why price came back to react from it. Now we have the next break of structure here. Yes, this is also a break of structure, because you might be wondering why I didn't mark it. This is a break of structure here. Okay, it's a break of structure, but price used this low here as a liquidity when it came back down. Maybe if we go to lower time frame, we will see where price is reacting from, but this is a fair value gap that price came to react from. And also we have a breaker block here, a breaker block here. but I'm not talking about breaker block here. So now we had this break of structure. After this break of structure, where is the last candlestick before the break of structure? Look at the impulsive move. This is the last. This is the last candlestick. What did price do? Price came back into it. So instead of having supplies now, because we are buying, we are now having demands. Demands. And what did we have? We have a new break of structure. This is not a break of structure on this time frame, okay? If you go to lower time frame, you will discover it's a break of structure. But on this time frame, it's not a break of structure. But in a lower time frame, it is a break of structure. So which zone did price react from? This is the candlestick that price reacted from. Now, and then came back, break this structure again. Where is the last candlestick? Sometimes price might not come back to that zone. This is the last candlestick before. Did you see that price did not come back to it? Did not touch it. But where did price react from? Price reacted from the fair value gap. See it? It reacted from the fair value gap, bullish fair value gap, and moved to the upside. Now, the moment we got a break of structure, this is the next break of structure we got. The moment we got this break of structure, we have this as one of our demand. Price can get to it and it might not get to it. So it is, you have to wait for price to get to that zone. This is another zone we have, another demand zone we have here. So price will use here as liquidity, but this zone is a very likely zone for price to react from, and we also have a fair value gap here. So when you are marking, you mark everything that is possible. Now, when price came back into that zone, what happened? You see, price did not react from it, but rather what did we have? We have a push to the downside. Now it came to react with this zone that price did not react from. You see it? This zone that we left for a long time now, price came back to it after a long time and reacted. See, because history must repeat itself. But this is for our time frame. In a lower time frame, this move to the downside, you can still see price doing the same thing. What did price do? It was selling, came down, retraced, break structure, came back down, retraced to the supply, break structure again, retraced into the supply, break structure, retraced into the supply, break structure, retraced into this fair value gap. Now, see what price did now. After this break of structure, price retraced back into this last candle. After this next break of structure, price came back into this zone. Now, after this next break of structure, so that's how to mark your supply zone. The last candle before the bullish, it can be a buy candle or a sell candle. What did price do? It retraced back into this last candle before the impulsive move. Look at it here. You see that? See that? This candle up that looks like. You see the way price came back into it and then broke structure here. So you must go back into your chart and check out for all of these things. When you learn to see it, now this is the last candlestick before. Look at this massive move that broke structure. So you go back to look for the last candle. This is the last candlestick. Now draw it to this side. If price comes back to it anytime in the future, it will react. You see it? See the way price reacted. Before then, price is reacting from all of this fair value gap and was selling and was selling. But now it has broken that stage because it's now in kind of a bullish move. But now let's read this narrative. After this massive move from this demand, because you need to look from the higher time frame. After this massive move, look at the impulsive move. There was a break of structure here. This is the last candle before that break of structure. And what are we seeing here? Price came back into it and tap into it. So in this situation where we are having a move of the from the higher time frame now, the buyers are in charge. This candlestick, this supply zone will not be able to hold price because from the higher time frame, the buyers are now in charge. So you must know, check your narrative to know who are those that are in charge. Initially, the sellers are in charge until this high was taken. This is a market market structure shift. So there is a change of character here to the to bullish trend instead of the initial selling trend. So we are now expecting by every supply zone will be taken out by the demand. So we see price reacted from this. After we add this break of structure, where is the next zone? Somewhere around here, and price came back down to react from it. So we have gotten this reaction from this zone now. Now, what is price doing? What is price doing? Price have taken this eye, has taken this eye to tell you he has what? Shift structure to start buying. Just the same way it happened here. Just the same way it happened here. So we are expecting more push to the upside. Maybe this selling pressure now can just come back to this low, take out this low, maybe by tomorrow morning, take out this low into this candlestick, possibly, then we start buying. But if we go down to the lower time frame, we might get a zone that price wants to react from. Yes, you see this black candlestick is a zone that price can want to react from. Okay, so but this low, these are liquidity. All of these, they are liquidity in price. So this selling pressure would want to sell into this demand zone, into this demand zone. So yeah, so I think I have done justice to this supply and demand using many examples and all of that. But now you should understand that there are mistakes that traders make in the market. And what are those mistakes? Imagine that, let's take this guy for an example now. This um, this is a break of structure here. Now you mark this zone as your demand zone. You mark this zone as your demand zone. What happened? Price came into it and bought all the way up to this point, but did not break this up. Did not break this stop. And even if it breaks it, now anytime price is coming to this zone again, there is a tendency for price to break this zone because there are many liquidity packed under here. Now, mistakes that traders make is to want to start buying from this zone again. When you do that, the price market can decide to what, take you down, tap into this new zone that have not been mitigated by price and start buying all the way up. So your stop loss will be taken. So avoid making that mistake, taking your trades from zones that have been tested or that have been mitigated. Now, stop ignoring what the higher time frame is saying. Imagine that, do you know this is also a supply? This zone here, this candlestick here is a supply. Okay? This is a supply. This is a supply zone. Now, price is coming from a demand zone on a higher time frame. Now, moving from this um, demand zone towards this upside, if we check from our daily time frame and see what the price is saying, that the market is buying, is reacting from a demand. This is the demand, is reacting. This black candlestick, it has reacted from it, it cleared out the liquidity, and now for about 3 days now, is reacting, is buying. So we are expecting that price should either come to this supply here and sell all the way down, or should come to this high here, which is our liquidity, our buy side liquidity. So on our higher time frame, we are expecting more buys. Now, you now go down to your lower time frame and you now see that price is responding to a supply, and you are now selling, and you are selling, and you are expecting it to sell to this point. Of course, this is reacting from a higher time frame demand zone. We are expecting that it should push all the way up to somewhere around here. This is a better supply that price should come to, and not this. So it means that we will be price will be respecting demands more than this supply. So when you get to this supply here, when you see a change in direction signaling to you that sellers wants to, excuse me, sellers wants to get into this market, then you should close up your buys and start looking for selling position to take out this low. So that is one of the mistakes that traders make. They are not looking for the higher time frame narrative. They'll just come to their 15 minutes and then want to look for demand and supply, and they are taking their trade from a supply, but they are being taken out because that supply is not from a higher time frame narrative. Okay, so another thing that you need to do in your supply zone, seek for confirmation. Don't just enter, seek for confirmation. If I want to buy here, I want to see the market telling me I am willing to start buying. Now it comes here like this, move up, come back down, and then push up this way. Then I will know that, okay, it's ready to buy. I'll be looking for a demand zone here to enter my buy to go up. So this is like one of my confirmation pattern. Is a confirmation pattern for me. Okay, it's a confirmation pattern. This is a sweep of liquidity and a break of structure, and then what? Return back to demand, and boom, you go. I think I took a buy based on that, but that is not what we are not looking for. Confirmation entry on this video. What we are looking at is how to spot supply and demand. So avoid making all of these mistakes, not entering without confirmation, and then ignoring what the higher time frame is talking about. Now, what again? If your supply zone is not fresh, if it has been mitigated, please don't be too quick to take that trade, except you get a confirmation. Except you get a confirmation. So I think that is the much I would be talking on this video. Please, if you are new to this channel, do well to like and also subscribe. Hit the notification bell so that whenever I drop new lessons, you would be able to be notified on those drops and when due. Thank you. very much for being a part of this channel. For those that have subscribed, see you next time in my next video. Have a wonderful trading week.